Hello, you are welcome to my accounting channel. I will first introduce myself. My name is Daniel Amako, an ACCA chartered accountant. I have provided accounting services such as bookkeeping and other accounting services for more than 20 years. I'm also an accounting teacher. Today, the lesson that we are going to learn is accounting equation. So let us get into the video. This is the notes that I prepared for this particular lesson. I will explain these notes to you. I've made it so simple so that you will easily understand the accounting equation after you finish. So let's start. So the topic today is the accounting equation. We are learning objectives, meaning of accounting. We are going to learn A, accounting capital. Also B, assets. C, liabilities. And then D, the accounting equation. What I mean is that these are the terms that we use in accounting. So we are going to explain all these terms for you to understand before we get into the accounting equation itself. So let's go on. A, capital. So when we say capital, what's the meaning of capital in accounting? This is the amount of resources provided by the owner of a business. It is also known as owner's equity or net worth because it is the amount of money or in kind the business owes to the owner. B, asset. What's the meaning of asset? This is the actual resources used to run the business. This consists of all kinds of properties such as motor vehicles, building, stock of goods, debts owed by the customer, money in the bank, and machinery. C, liabilities. What is the meaning of liabilities? When we say liabilities in accounting, it means that the amount owed by the business to other people or to third parties. That is the amount owed by the business for goods and services provided for goods and services supplied to the business and other expenses incurred by the business that have not paid yet, that have not been paid yet, sorry. It also includes funds borrowed by the business. Let me pause here and explain this. Before anybody can start a business, the person should provide money or income to start the business. The money that the person will provide is called capital in accounting. So it is the amount of money or income provided by the owner. Then this capital will be used to run the business. So that capital that has been provided to run the business is called the assets. Apart from the owner providing their own capital to start the business, other cash or income, other third parties can also lend money to the company, or other parties apart from the owner can also provide cash or income to the company for that particular company to use to run the business. The third party provision of cash or income is called liability. I hope my explanation is well understood. Let us go on. D, a business starts with an amount of resources provided by the owner of the business. That is the accounting. Let me go back. D, a business starts with amount of resources provided by the owner of the business. That is the accounting equation becomes capital is equal to assets. As I explained, once the owner has provided cash or income, it's a capital. And this capital is the same as what the assets, implying that this capital is going to be used to run the business. That's why we call assets. So that's why we are saying that the capital is equal to the assets. E, if other people provide resources to run the business, then the accounting equation becomes asset is equal to capital plus liability. So as I said, if a third party also provide money apart from the owner to run the business, then that is a liability to the company. So the total worth of the company, that the asset will be the capital provided by the owner plus what third parties also have provided to the business. That is the resources of the business. That is the assets will be equal to those who supply them. That is the capital provided by the owner plus the third party's provision of cash or income called liabilities. It can be seen that the two sides of the accounting equation will have the same total. This is due to the fact that we are dealing with the same thing from two different points of view. It can also be presented as capital is equal to asset minus liability, which is the same equation that has been turned around. Okay, let's continue. That is the resources of the business, that the asset is equal to those who supply them, the capital plus liability. It can be seen that the two sides of the accounting equation have the same total. This is due to the fact that we are dealing with the same thing from two different points of view. It can also be presented as capital is equal to assets minus liability. Now let's work some examples so that you understand it better. We are going to go through a lot of examples. The reason why we are going through a lot of examples is that accounting is a principle. So the more you work on the principles, the more you go through examples, the more you work on the more you become perfect, the more you grasp the principle. So let us go through. Example 1. Morrison started a business with $10,000 in cash. Record this in Morrison accounting books. Before we go on. In accounting, we have a concept by name double entry. Double entry means that every transaction has two effects. That is, every transaction affects two accounts. We have one, an account that is giving, and two, an account that is receiving. So in the accounting double entry concept, there's no transaction that can be recorded single. Every transaction has to be recorded twice because there's one giving and the one receiving. So the double entry principle simply means that the transaction should be recorded twice. I hope you understand me. Transaction should be recorded twice because the accounting, whenever a transaction is done, there's one account receiving cash and there's one account giving cash. And there are principles laid down for the accounting equation. I've treated this topic in my first video, so you can go and watch that particular video, the accounting equation. So let us go on. So this transaction, example 1, Morris started a business with 10,000 in cash. Record this in Morris accounting books. So we are going to record the transaction in Morris books, and we use the double entry concept because it's a transaction that has to be recorded twice. So let us go through. The double entry concept says that first, in Morris Limited books, we have to identify the two accounts involved. And the two accounts involved are 1 or I, capital account, and II, cash account. Okay. Then the second concept, the second principle is that after you have recognized the two accounts involved, then you go on to B. You identify the account receiving, that is the cash account, it should be debited. II, the account giving out, capital account should be credited. Let me explain. It means that after you have identified the two accounts involved, here is the capital account and the cash account. The second step is that the account that is receiving the cash should be what? Debited, and it is the cash account. And the second account that is giving out money, that is the capital account, should be credited. Then the third step is that you draw your T account. That is C. You draw your T account. The left-hand side is for debit entries and the right-hand side is for credit entries. So in the example above, in Morris Limited books, the cash account, it should be debited with $10,000. The reason why we have capital, $10,000 means that it can be, a corresponding entry can be found in the capital account. So when you come to the capital account, we have cash credited with $10,000. The cash implies that the corresponding entry can be found in the cash account. The T account, let me explain. The T account shows the double entry in Morrison Limited books. The account receiving, that is the cash account, has been debited with $10,000, and the account giving out cash, capital account, has been credited with $10,000. Then the accounting equation will be cash $10,000 is equal to capital $10,000. Okay, let's look at more examples. Example 2, Morrison bought a car from Roxy Limited, $2,000, paying with cash, record this transaction. So we apply the same double entry principle. The first step is A, in Morris Limited books, identify the two accounts involved. And the two accounts involved are I, car account, II, cash account. Then the second step, after we identify the two accounts involved, the second step, the account receiving, that the car account, it should be debited. II, the account giving out, cash account should be credited. So it means that after you identify the two accounts, then the account that is receiving, which is in this particular case, that is the car account, should be debited. And the account giving out cash, the giving out, that is the cash account, should be credited. Then the third step, C, you draw your T account. The left-hand side is for debit entries and the right-hand side is for credit entries. So in the example above, in Morrison Limited books, you have the car account debited with $2,000 cash. The cash means that the corresponding entry can be found in the cash account. So we come to the cash account. We have credited $2,000. It's car $2,000, implying that the corresponding entry can be found in the car account. The T account shows the double entry in Morrison Limited books. The account receiving, the car account, has been debited with $2,000, and the account giving out, the cash account, has been credited with $2,000. Note, the cash account will be $8,000. Why? Because it was previously $10,000 and $2,000 has been taken out. And the $2,000 is a new asset, car, $2,000 has been added to the assets. That means when you go through, we initially have $10,000, but because $2,000 have been taken out to buy the car, the cash now has been reduced to $8,000, and a new asset, car, $2,000 has been added. The accounting equation will be assets, $10,000, comprising cash, $8,000, plus $2,000 car, all will be equal to capital, $10,000. It can be seen that the accounting equation still remains the same. Asset is still $10,000, comprising of cash, $8,000, and car, $2,000, all will be equal to capital, $10,000. that remains unchanged. Let us work more examples. Example 3. Morrison Limited transferred $4,000 cash into the bank account. Record this in Morrison Limited books. So we use the double entry principle to record this. So A, the first step, according to the double entry principle, in Morrison Limited books, identify the two accounts involved. I, the bank account, I, the cash account. After you have identified the two accounts involved, you go on to the second step. That is B, I, the account receiving, the bank account, it should be debited. I, the account giving out, cash account should be credited. Then you go on to your C, your T account. And as I've said, the left-hand side is for debit entries and the right-hand side is for credit entries. So in the example above, in Morrison Limited books, the bank account, we have to debit it with cash, $4,000. Cash means that the corresponding entry can be found in the cash account. Bank credited with $4,000. The T account shows the double entry in Morrison Limited books. The account receiving, bank account, has been debited with $4,000, and the account giving out, cash account, has been credited with $4,000. Now note, I, the cash account is now $4,000. Why? Because it was previously $8,000, and $4,000 was taken out and deposited in the bank account. So that is II. A new asset, bank account, $4,000 has been created. The accounting equation will be asset is still $10,000, comprising of cash, $4,000, plus car $2,000, plus $4,000, which is from the bank. And all will still be equal to capital, $10,000. It can be seen that the accounting equation still remains the same. Asset is still $10,000, comprising of cash, $4,000, car $2,000, and bank $4,000. All will equal to capital $10,000. That remains unchanged. More examples. You go on to example 4. Morrison bought office furniture from Morgan Limited, $1,000, paying with cash. Record the transaction. So the double entry principle applies here. The first step, in Morrison Limited books, identify the two accounts involved. And the two accounts involved are I, furniture account, II, cash account. Second step, B, the account receiving, furniture account, it should be debited. II, account giving out, cash account should be credited. Then we go on to the third step. The third step, the T account. And I've stated, the left-hand side is for the debit entries and the right-hand side is for credit entries. So in the example above, in Morrison Limited books, furniture account, cash, debited with $1,000, because the corresponding entry can be found in the cash account. So when we come to the cash account, furniture, credited with $1,000. The furniture means the corresponding entry can be found in the cash account. The T account shows the double entry in Morrison Limited books. The account receiving, furniture account, has been debited with $1,000, and the account giving out, the cash account, has been credited with $1,000. Now note, the cash account is now $3,000. It was $4,000, and $1,000 was taken to buy the furniture. That is the I, a new asset, furniture, $1,000 has been included. The accounting equation will be asset still $10,000, comprising of cash $3,000 plus $2,000 car plus $4,000 bank plus $1,000 furniture. It will still equal to the capital account of $10,000. It can be seen that the accounting equation still remains the same. Asset is still $10,000, comprising of cash $3,000, car $2,000, bank $4,000, and furniture $1,000. All will equal to the capital $10,000, still remain unchanged. Now, example 5. Morrison bought computer for $900. Sorry. We've checked. Record this transaction. So we apply the double entry principle. The first step, in Morrison Limited books, identify the two accounts involved. I, the computer account, II, the bank account. After identification of the two accounts, then go on to the next step. B, that's the next step is B. Account receiving, computer account, it should be debited. Account giving at bank account should be credited. Then the next step, the T account. The left-hand side is for debit entries and the right-hand side is for credit entries. So in the example above, Morrison Limited books, computer account, bank, $900. The bank means the corresponding entry can be found in the bank account. So when we come to the bank account, computer, $900. Computer means the corresponding entry can be found in the computer account. The T account shows the double entry in Morrison Limited books. The account receiving, computer account, has been debited with $900. And the account given out, the bank account, has been credited with $900. So you note that the bank account is now $3,100. Why? It was $4,000 and $900 have been taken out to buy the computer. So that's why I see that a new asset, computer, $900 has been included. The accounting equation will be still asset, $10,000, comprising of cash, $3,000, plus $2,000 car, $1,000 furniture, plus $3,100 bank, plus $900 computer. It will still equal to the capital of $10,000. It still can be seen that the accounting equation still remains the same. Asset is still $10,000, comprising of cash, $3,000, car, $2,000, furniture, $1,000, bank, $3,100, and computer, $900. All will be equal to the capital of $10,000. That remains unchanged. Example 6. Suppose Morrison borrowed cash, $50,000 from Mr. Hunter to support his business. Record this in Morrison account. So the double entry principles apply. A, the first step, in Morrison Limited books, identify the two accounts involved. And they are I, the cash account, II, Mr. Hunter account. The second step, the account receiving, cash account, it should be debited. II, the account given out, Mr. Hunter account should be credited. The third step, the T account, the left-hand side is for debit entries and the right-hand side is for credit entries. So in the example above, in Morrison Limited books, the cash account, Hunter, $50,000. The corresponding entry can be found in Mr. Hunter's account. So Mr. Hunter's account, cash, $50,000. The corresponding entry can be found in the cash account. The T account shows the double entry in Morrison Limited books. The account receiving cash has been debited with $50,000. The account given out, Mr. Hunter has been credited with $50,000. For he has borrowed to Mr. Morrison and has now become a liability to Mr. Morrison. Let me explain this. You know, Mr. Morrison borrowed money from Mr. Hunter. Mr. Hunter is a third party. So once he has borrowed money to the business, he has now become what? A liability to the company. In accounting, we say that he is what? A payable to the company because the company is now owing him. And the amount involved is $50,000. So note, the cash balance has been increased by $50,000 and the liability of $50,000 created. Why? Because Mr. Hunter is a payable to Mr. Morrison business. As I said, because he's a third party, borrow money to the business, he's now a liability to the company or a payable to the company. So the accounting equation will now be the asset is now 60,000, comprising of cash 53,000. It was $3,000 remaining, and 50,000 was borrowed from Mr. Hunter. So right now the cash is now $53,000 plus $2,000 car plus $1,000 furniture plus $3,100 bank plus $900 computer, all be equal to capital $10,000 plus the liability from Mr. Hunter, $50,000. So you can see that the asset is $50,000. It equals a capital of $10,000 plus liability $50,000, making up also $60,000. It can be seen that the accounting equation has changed. Asset is now $60,000, comprising of cash $53,000. That is, we have car $2,000, furniture $1,000, bank $3,100, computer $900, and it equals to capital $10,000 and a liability $50,000. Well, we have come to the end of our lesson. Let us go to what we've learned today. So our learning outcomes are A, we know what is capital. Capital is the amount of resources provided by the owner of a business. It is also known as the owner's equity or net worth. B, we have also learned the meaning of asset. And the asset is, when we say asset in accounting, it means this is the actual resources used to run the business. This consists of all kinds of properties such as motor vehicles, building, stock of goods, debt owed by the customer, money in the bank, and machinery. C, we also know what is liability in accounting. And liability is the amount owed by the business to other people. That is the amount owed by the business for goods and services supplied to the business and other expenses incurred by the business that have not been paid yet. It also includes funds borrowed by the business. D, what we've learned today, the fourth thing is that if you know the accounting equation now, the accounting equation says the capital is equal to assets. E, if other people provide resources to run the business, then the accounting equation will be asset is equal to capital plus liabilities, or capital is equal to asset plus liabilities. So we have accounting equation means that whenever anybody starting a business, the person will provide money or in kind. The money or in kind is the capital provided by the owner. Then the owner will use that particular money or in kind to run the business, so it becomes an asset. That's why you have to say the capital is go to assets, or assets is go to liability. But when a third party comes in and borrow money to the business, as in the example that we saw, Mr. Hunter borrowed money to Mr. Morrison to run the business, you become a liability to the company. So the accounting equation will now become asset is go to capital plus liability, or capital is go to asset minus liability. The two sides of the equation will always be equal. This is due to the fact that we are dealing with the same thing from two different points of view. We have come to the end of the business. We have come to the end of the video. Thank you very much for watching. Please like and share for encouragement, comment for improvement, and also subscribe for more weekly videos, because as I've started every week, I'm going to provide videos on various accounting subjects. So when you subscribe, it can be sent to you whenever a new video is made. As I've said, I provide bookkeeping and other accounting services, including also providing teaching services. If you want me to help you, either to keep your books or to teach you accounting, you can contact me. Thank you very much for watching. Please watch out for my next video. Bye.